Every major AI company depends on one key player, TSMC. As demand for advanced chips explodes, this company is at the center of it all. Let's break down why it matters. We are discussing on the FinTalk channel.
Welcome to a brand new deep dive. I'm really glad you could join us today because our mission, well, we've got a fascinating one today. We're unpacking the first quarter 2026 earnings presentation and the management report from TSMC.
Yeah, the Taiwan Semiconductor Manufacturing Company. And I have to say, calling this just a financial update feels like a massive understatement.
Right, really not.
No, it's really a rare look inside the actual engine room of the global tech economy. Like, this is where you see the gears turning.
Exactly. And, before we even get into the weeds, I just have to marvel at the sheer scale of the numbers they just posted. Because, frankly, they defy traditional logic.
Oh, they're completely mind-blowing.
Yeah. Get this. In just 3 months from January to March 2026, their net revenue hit a staggering 1,134.1 billion new Taiwan dollars.
Which is, just to convert that for everyone, that's 35.9 billion US dollars in a single quarter.
In 90 days. I mean, that is an 8.4% increase from just the last quarter, and it's a massive 35.1% jump from Q1 of 2025.
Yeah, year-over-year growth like that at their scale it's almost unheard of.
Okay, let's unpack this. Because the tension between what they actually do and how much money they make is, it's really what makes this report unique.
Right, because they don't sell directly to you and me.
Exactly. I like to think of it like this. Most hardware manufacturing is just a grind for pennies. Think about, running a massive global restaurant chain.
Oh, that's a good analogy. Lots of overhead.
Right, huge overhead. Your ingredients spoil, commercial rent is astronomical, utility bills are all over the place, you've got thousands of employees.
And you're fighting for every customer.
Exactly. If you clear like a 10% profit margin at the end of the year in that business, you are an industry legend.
Sure.
But TSMC, they are pulling in software-level profits, like a scrappy tech startup that only pays for a few cloud servers.
What's fascinating here is the exact breakdown of those margins in the report, because they validate your analogy perfectly.
Well, I was looking at those gross margins.
Yeah. The gross margin, which is basically the money left over after the direct costs of making the chips, is 66.2%.
That is just wild for a physical product.
It really is. And that's up 7.4 percentage points from last year. And then their operating margin, which factors in all the corporate overhead and R&D, is still sitting at 58.1%.
Okay, wait, over 66% gross margin? How do they pull that off when they're buying raw silicon and operating these giant, ultra-expensive factories?
Well, the management report points to three main things. They highlight really rigorous cost improvement efforts.
Okay, so just being more efficient.
Right. Plus, favorable foreign exchange rates. The average exchange rate was around 31.59 new Taiwan dollars to the US dollar, which helped them out.
Okay, that makes sense.
But the biggest factor, higher capacity utilization, which just means their factories are constantly full.
Like they'd never turn the machines off.
Exactly. In normal manufacturing, if demand drops, you turn off the assembly line to save money. But semiconductor fabs are these massive clean rooms. They have to be temperature controlled 24/7.
All right, you can't just flip a switch and go home for the weekend.
No, if a fab sits idle, you burn millions of dollars a day. So their insane profitability comes from the fact that they have a line of the world's richest companies basically wrapped around the building, begging for factory time.
Begging for time to build microscopic products, which is a perfect pivot because the financial numbers are jaw-dropping, but to understand why they make so much money, we really have to look at what they are physically selling.
Yeah, the product mix is where the real story is.
So let's dive into the breakdown of wafer revenue by technology. Because I originally assumed their older established chips would be the cash cows.
Oh, like the chips they've been making for a decade.
Yeah, the ones where the research is totally paid off.
Yeah.
But looking at the data, advanced technologies, which they define as 7 nanometer and below, account for a whopping 74% of their total wafer revenue.
It's a huge chunk.
It's almost 3/4 of the business. And looking at the specifics, 5 nanometer is the biggest slice at 36%. 3 nanometers right behind it at 25%. And 7 nanometer makes up 13%.
Meanwhile, the older stuff is barely a blip.
Exactly. Older tech like 16 and 20 nanometer, and the 28 nanometer, they're sitting at just 7% each.
Yeah.
And wait, get this, 65 nanometer and 90 nanometer barely register at 4% and 1%.
Right. It completely flips traditional manufacturing logic on its head.
It really does. I mean, wait, 74% of their revenue is coming from microscopic tech that didn't even exist commercially 2 years ago. It's like a car company making 75% of its money on levitating cars.
That's actually pretty accurate.
But I have to push back here. Is it risky for them to be so reliant on the absolute bleeding edge? Like, what if Apple or NVIDIA takes a year off? Shouldn't they want a fatter cushion of those older, reliable nodes?
It seems risky, right? But it's actually not. Because this isn't a normal market. It's a monopoly on the future.
A monopoly on the future. I like that.
They aren't hoping someone wants to buy these advanced chips. The demand for leading-edge process technologies is the exact thing driving their 8.4% sequential revenue growth.
Because all the big tech companies literally have no other choice.
Exactly. You can't train a modern AI on a 10-year-old chip. And the global hunger for this tech is proven by their wafer shipments. They hit 4,174 key PCs, that's 1,000 pieces, 12-inch equivalent wafers, in just one quarter.
Over 4 million wafers. Wow.
Yeah, and that's a 28.1% year-over-year increase. The demand is voracious.
Okay, so that naturally leads to the next question. Who exactly is buying up all these millions of advanced 3-nanometer and 5-nanometer chips?
This is where you see the tectonic plates of the industry shifting.
Yeah, let's look at the revenue by platform, because the center of the tech universe is definitely changing. High-performance computing, or HPC, now represents 61% of their net revenue.
61%, that's huge.
It absolutely dwarfs smartphones, which are sitting all the way down at 26%.
Which is wild when you remember that smartphones used to drive the entire silicon industry.
Here's where it gets really interesting. Look at the quarter-over-quarter growth rates. HPC grew by 20% in just 3 months. Digital consumer electronics jumped 28%. IoT grew 12%, and the others category grew 17%.
But smartphones?
Smartphones actually shrank by 11%, and automotive chips shrank by 7%.
If we connect this to the bigger picture, it tells us something profound about where we are. The world has fundamentally shifted.
How so?
For the last decade, the phone in your pocket was the main driver of the global tech economy, right? Every year, a new phone, a new chip.
Right, the upgrade cycle.
But now, that phone is no longer the undisputed king. The growth is all in high-performance computing. We're talking massive data centers, cloud servers, AI, supercomputers.
The stuff that runs in the background.
Exactly. And if you look at the geographic context, it confirms this.
Oh, yeah. The geography breakdown is fascinating. North America is a massive 76% of total revenue.
76%.
Yeah. While the Asia-Pacific region is at 9%, China is at 7%, and Japan and EVA, so Europe, Middle East, and Africa are sitting at just 4% each.
That's 76% in North America. That's the footprint of the hyperscalers.
Like Amazon, Microsoft, Google.
Yes. They are buying up every advanced chip they can to build out AI infrastructure. North America is basically a black hole for advanced silicon right now.
But keeping that crown in high-performance computing and feeding that black hole, it isn't cheap.
No, not at all.
Which brings us to the cost of the future. The capital expenditures, or CapEx. I saw this number and I honestly had to double-check it.
The big one.
For Q1 2026, their CapEx was $11.10 billion US dollars. That's 350.76 billion new Taiwan dollars in a single quarter.
Yeah, just wrap your head around that.
And put that in perspective, they're spending the equivalent of the GDP of a small country every 3 months, just on facilities and equipment.
It's basically $120 million a day.
How can they possibly sustain this without running out of cash? I mean, 11 billion out the door in 90 days sounds like a terrifying burn rate.
In any other industry, it would be a huge red flag. But you have to look at their cash flow statement to see the full picture.
Okay, walk me through it.
Despite spending that $11.1 billion on CapEx, TSMC generated 698.97 billion new Taiwan dollars in cash just from operating activities.
So the daily business is printing money.
Exactly. When you subtract the CapEx, their free cash flow is still a very healthy 348.21 billion NT dollars.
Oh, wow. So they're funding the most expensive factories on Earth out of pocket.
Pretty much. But there's another detail on the balance sheet that's super interesting. It's regarding their inventory.
Yeah, I noticed that. Days of inventory went up by 6 days, right? From 74 days at the end of last year to 80 days in Q1.
Yeah. Now, normally inventory going up means your products aren't selling, they're just sitting in a warehouse.
Right, which would be bad. But the management report explicitly defends this. They say it's due to the N2 ramp and stronger N3 demand. So what does this all mean? Are they just sitting on billions of dollars of raw materials?
Well, yes and no. In semiconductor manufacturing, inventory isn't just finished chips. It takes months to make a single wafer. So TSMC is already hoarding inventory and prepping the production lines for the 2-nanometer generation. That's the N2.
Oh, so they are gearing up for the next leap while everyone else is still fighting over the current one.
Exactly. They are completely unbothered by their massive spending because their profitability is so immense. They know the demand for N2 is already locked in.
That's incredibly confident.
Yeah.
And honestly, you can see that confidence carrying right over into their guidance for the future.
Oh, the management guidance is practically a victory lap.
It really is.
Yeah.
Let's bring it all home by looking at what they project for Q2 2026. They expect revenue to be somewhere between $39.0 billion and $40.2 billion US dollars.
So even higher than Q1.
Yep. And they expect an even higher gross profit margin, between 65.5% and 67.5%. And that's based on an exchange rate assumption of 31.7 NT dollars to the US dollar.
Pushing almost 68% margin on a physical good. It's wild.
And for the full year of 2026, TSMC expects revenue to increase by above 30% in US dollar terms.
It's staggering growth for a company of this size.
It really is.
You know, it leaves us with one final kind of mind-bending thought pulled directly from their balance sheet.
Oh, I know what you're going to say.
The cash and marketable securities line.
Yeah, that number is insane.
At the end of Q1 2026, TSMC holds a staggering 3,383.60 billion new Taiwan dollars.
Which is roughly 94.67 billion US dollars.
Nearly $100 billion in cash reserves. They even declared a 6 NT dollar cash dividend just for Q4 of 2025.
So they're literally just giving cash back to shareholders, spending $11 billion on factories, and still have nearly $100 billion in the bank.
Right. So you have to ask yourself, and this is something for you listening to really ponder, when a single company holds the undisputed monopoly on the building blocks of the future, when they spend $11 billion a quarter just to maintain it and still have nearly $100 billion sitting in the bank, are they still just a traditional manufacturing company?
That's a great question.
Or have they become something entirely new, a kind of sovereign silicon state that the rest of the tech world merely rents from?
A sovereign silicon state. Wow, that really changes how you look at the device you're listening to this on right now.
It does. They are the landlords of the digital age.
They really are. Well, thank you all so much for joining us on this deep dive. Keep questioning the forces that shape your tech, and we will catch you next time.